Welcome to Burn Rate and Beyond. We are here with episode 16. My name is Chad Fultz, and here with the always smiley Jeffrey Mazza.
Hey guys, how are you?
Good stuff. And today, our topic of choice is building an investor-ready business. So this is obviously from the angle of finances. So I guess let's just kind of jump in and see what we got going on.
I love it. I'm excited.
So you had I guess Jeff, how about you take the floor? You had some interesting, thoughtful things to start off with. So
Yeah,
yeah,
I feel like it's such an interesting topic, especially any sort of business owner that they're usually like, oh, yeah, let's start this business. We can sell it, make millions of dollars, right? And it's great. In reality,
beginning.
it sounds very easy, but there's some challenges that come along. But I guess like when you start thinking about, say, selling, the business, I guess in your mind, I guess like what does that mean, I guess, to be kind of investor ready and any sort of like call it financial hygiene. Like what's kind of part of that, what just comes to mind when you think about investor ready?
Yeah, I guess so. When the things, yeah, that well, let's go. So the investor ready is something that you have something that you can present to investors that will give them an idea of, I think, three major things. One is what has happened to the business up until now, like what have you done to get to where you're at, or what is, financially what has happened. Two is what is what are the metrics of the business? Just specific metrics, financial metrics of the business need to be understood. And then three is like what's the plan? Like what's the projection? What's the future look like?
Yeah.
Um, so I feel like that's when you can either do that through a slide deck or through a few simple graphs, or a combination of various things. Then anyone who's thinking about taking the dive and risking some of their own hard-earned capital in your venture will at least have a starting point. Um, so that's what I think about. How about you? Anything to
Yeah, no,
add?
yeah, very similar, and even when we call like investor ready, because anytime I feel like you have that outside party, call it, looking to purchase as a target company, it's always like, okay, well, what does investor ready mean? I mean, they're going to start asking for a ton of information and docs and tying out, doing their work on it. So, but yeah, anytime you can really kind of fine tune the operations, the finances, the better it is in that whole process. It makes it smoother and even just complete it. Because there's been a few times where I've seen where that the transaction didn't take place because that target company who's selling it just doesn't have their ducks aligned. So that's where I would think about it too.
Yeah, and
Um,
it's a the and if you take a long time to get this stuff together, it also sends a signal that a little bit of dysfunction or lack of sophistication on the inside of the business, right? Which is also a bit of a red flag if you're an investor.
yeah, because like even just on top of that, like sometimes you see, especially, I mean, I think there's different types of investors, but you look at, call it just the general private equity firm, right? I mean, they who are purchasing it are not going to run it, so they want that well-oiled machine so they can just plug someone in there or, an earn out, any sort of the structure of the deal, but they just want it running smooth and producing money.
Yeah,
So
actually, that's interesting. So what, I mean, like if you had to break them into major categories, if you talked about that or thought about that at all, like like one thing is the institutional investor, like you just mentioned, like the
yep.
colleges, endowment funds, but there's other kinds too, right? There's at least few, right? How would you
Well,
break it down?
it is a good, I think when you look at like a business that are trying to either raise money from an investor or just sell the business, right? But in this case, if we're talking just bringing on an investor, it's almost like, well, why? Is it just for money? Like, what stage of the business is it in? Early stage, where most likely you're sucking cash for growth, and you just need some extra capital, to kind of get you to these milestones or point B, or is it a little bit more stabilized, and you're just looking to just, I don't know, get some extra capital to make acquisitions or whatever the really need is. But I mean, you're looking at a marriage, right? I mean, this isn't like just send us money, but as an investor, this is going to be someone or a company that you're going to be closely tied to. So doing the due diligence on them as well as you. But, I think it depends on the situation. And if you're looking for what's called a strategic partner, doing the due diligence of like the show The Shark Tank, right? Where sometimes those guys need the extra capital for a company, but it's nice to have someone on the other side that has connections and help them grow faster than
Mhm.
they normally would. It's not just money, it's partnerships and stuff too. So I think there's a lot I think to think about, but it comes down to, I guess, the situation of the business of why you're looking for money and um for that. But there's like the early stage, right? You might get the angel investor, that's like, I don't know, friends and family before that, and then some angel. And you're giving up a lot, I guess, they're taking a lot of the risk in the early stages, so you might be giving out a lot of equity. But as the business matures, it's easier to kind of take on additional investors and, kind of use that money for growth. But I don't know, your thoughts on that too, I guess, Jen.
Yeah, and I think I think when I was thinking about the investor ready business, I guess my mind initially went to a young company that's growing and scaling and is looking out to bring on capital. And so that's usually at the beyond the friends and family, like you're looking for the angel investors or starting with a series of investments um, at a higher level leading up to going public. But the idea is that um, what do you need to do? So I guess from my standpoint, it's like the the trade-off, right, is like you're giving up this control, right? And well, you're giving up control, you're giving up future equity, right? And up to a certain point, normally the founders are going to retain control. Um, but one of the key pieces when I was talking about the three different points of like being investor ready is the future. And part of what it revolves around is the strategic reason to do it now. Like why are you wanting to do it now versus three
Yeah.
months ago, 6 months ago, or a year from now? Like what is happening now that you actually need this cash now? And a big part of that is why and how much, right? Like a big part of why is how much, right? So it's like, okay, cool. Like to get to this next milestone, we need X number of dollars because we're gonna have to buy, do, there's a plan, there's a concrete plan. And I think the believability of the concrete plan is also part of a key part of actually this working, right? It's okay, cool. Well, you have a vision, and is that vision backed up by some sort of basis in reality?
Yeah.
Right? 'Cause I've talked to a lot of people who have really great ideas, and then I'm like, but I don't know of a world where that actually works.
Very true. I guess even on top of that's a good point of like why now? But even then, it's like, well, when should you start? I guess like a business say, hey, now's a good time. Let's go raise some money. But like, is that is it too late? Because it's not like you're going down the store buying a pack of gum. But I guess like when should someone start?
Yeah, and I think that there's like, I mean, people talk a lot about that whole like MVP, like the minimum viable product. They
Hmm.
got to get something to show, right? And so if they can show what that's like the very beginning, right? Like you get this MVP, but then from there it's like, okay, well, once you've built that, I think like the next stage that actually makes sense is like you got to get some traction, like understand, like prove that like what people are actually willing to pay for or willing to use your service. Like I was actually on the phone with another guy last week, and he's like, um how about you just use the platform for free, and then if you like it, then we'll talk about how much you're going to pay for it. I'm
Hmm.
like, you don't have a very good business model. Like you don't even understand how to like quantify what it is you're actually trying to sell, right?
Yeah.
And so that's also like there's a gap there where it's like, okay, well, we believe that the like that kind of gets back to like market research, and maybe that's where the phase the guy was at. He's like trying to figure out what people would pay for it. But it was very interesting to hear somebody say that on out loud on the phone in a sales call. I'm like, okay, well, hold on a second.
That's funny. Um, no, and I think that's such a good I guess point because even the was it the saying of it's easier to raise money when you don't need it, and then when you do need it, it gets difficult. But even then, it's like mapping it out. Like especially if you're early stage, like what does the next, 3, 6, months look like? What does the next year look like? And try to have like that visibility to know, here's how much we need to get us to these milestones, right? And starting that process now, because you could go months without getting an investment,
Yeah.
an investor, let alone, the debt from a banking institution of some sort. But if you're just looking for equity investors. So, um, I guess, when it comes to just that, right, of like, what makes, I guess, like because like a lot of times, an investor might say, well, what's this money used for, right? What should someone be thinking about, I guess, when looking for an investor? They know the time is right now, but like, what should they kind of get in place to get ready?
Yeah. Well, actually, hold on. I just saw another note here about outcomes.
Mhm.
Like you mentioned here in our show notes that what are the three outcomes this capital unlocks that we cannot achieve bootstrapped? I'm like, interesting. Yeah, because I think that there's also that concept of like, by bootstrapping, right? You're like you sell a little bit, you build a little bit, you sell a little bit, you
Yep.
build a little bit, sell a little bit, you build a little bit, right?
Hmm.
And I guess I guess in my mind the thing that comes out is accelerated growth is the
Hmm.
main outcome. But you're saying you mentioned three in our show notes, so I'm curious what other ones you were thinking about that would be.
Yeah. And because just like you said, like a bootstrap, you kind of could say, all right, we're going to just do this organic growth and it might take a long time, right? And if you, let's say, map out, you know, we're just doing X amount, or maybe we're slightly losing money, we're early stage, but you are find an investor that will give you a few million bucks, whatever that number is, of just capital that you say, hey, we can infuse this capital in our business. Now we can, like you said, now we can grow faster, right? And I was kind of alluding to like maybe there's some sort of acquisition, to kind of help fuel that, or hire more people so you can grow faster, or
Hmm.
maybe it's a different facility, or buy more merchandise, just to be able to, or a sales team, so like those are some of the areas that if you were bootstrapping, you still could do that, but it might take a lot longer. So that was kind of what kind of alluding to of what are some of those outcomes if you got this big capital infusion into your business to help you
You
grow.
could go through like the develop. We could be like we could develop faster,
Yeah.
with the development team, or we could sell faster with a sales team, or we could what was the third one we were thinking about here? Just yeah, the acquisitions piece where we could either do a strategic purchase or some sort of merger and acquisition move
Hmm.
that changes the trajectory of the format of the business, which is interesting.
I love it.
Cool, cool. Let's see here. I guess what about instruments? You talked about a couple different. This is like being investor ready. So I think part of the when we were talking about different instruments like debt, equity, et cetera, right? Or different even types of investor agreements
Hmm.
um, lead to, part of the getting ready is having an ideal outcome. Like, do you want to have more equity than debt? Do you want to have more debt than equity?
Yeah.
Which investors do you want? How much control are you willing to give up? So you need to have those parameters set up. Um, and and so I think that's part of the prep, right? Getting ready for this investor ready
Yeah. Um,
phase is having an idea of what that looks like. Do you have any like high level or any comments to add to give clarity with how those decisions can be made?
yeah, just from even just experience, right? Of you come across like, even like we were kind of talking about, like just understanding kind of where you're at in the business. What do you need? Is it a strategic partner to help? Is it just cash? And that can help. It kind of gives you these doors to go down. Like, because if it's just cash, then it's like, do we take on an investor, or is it through like a banking institution where it's debt or equity? Or if it's a strategic partner, most likely it's going to be some sort of equity raise of some sort. But either way, just understanding kind of what area that you need. And then it's like, if it's a just cash, then it's like, well, there's a lot of different options when it comes to, not only from the equity side of just like literally an investor giving you money to take control of some ownership, but their debt side of it. And even from the debt side, a banking institution is going to want to have your financials and everything's got to look nice and clean so that they feel comfortable that, this isn't a grant where they're just giving money, like they want money back with a interest rate. Same with an investor, but they're taking on more risk. So, debt can be cheaper than equity. Because investors are going to want a higher return as well as take over some ownership too. But so I think number one is just starting of like, why do you need funds, right? And just determine which
Yeah.
path to go down. But then it's like, they have different instruments, the convertible debts and the safe, where you're not giving up equity right now, but it's going to convert later. So there's a whole different, you go down a rabbit hole once you start talking about different areas. But I think for me, it's just starting of what do you need the money for?
When you get into that concept of, like you say, debt is cheaper than equity. Like if I put my investor hat on, I'm like, and I look at a balance sheet, I don't want to see a company debt laden with a bunch of debt.
Hmm.
Right? Like I'd much rather see, even if it is scaling, I'd much rather see a company that's maintaining a good balance of, what do you call it? Like an asset ratio, right? An asset test ratio, where it's like, okay, well, do we have enough cash to deal with our current liabilities in the short term? So you don't want to, get overcommitted on debt with without having enough equity and cash to be able to deal with it. So I think that's a big concern I've heard multiple times, where it's like, okay, well, step one is like just get rid of the debt somehow, figure out how to get
Hmm.
rid of the debt, and then it'll be significantly more attractive to investors. And it depends on it depends on the type of business we're talking about here. Is like if we're talking about like a capital heavy business where there's uh, you know investments or machinery or real estate or whatever you want to call it that need to be bought. But if it's a software business, that's like, okay, well, really we're just building something and paying people, when there's a bunch of different ways to do that too.
Yeah.
So, um,
And there's tools, right? And this goes even back to, years in school, but it's the WACC, right? The WACC, which is the weighted average cost of capital. And it really,
mhm.
I mean, it's formulas, but you can kind of look at what is that cost of the debt and the cost of equity, and kind of coming up with a good, number to say, all right, well, here's a balanced structure, right? If you have equity and debt on the books, and kind of seeking different paths, but it's good to, I mean, early on you might not need to know that, but as you grow, it's nice to just start looking at that stuff.
Interesting. Yeah, I mean, I think we should add some reference there for in the show notes as well. That's good.
Sure.
It's not a good one. What about the timeline? Like, do you have like I mean, I know you've been out on the road looking for investors and different um, helping companies court investors. Like, is there a normal timeline? Like, if it's taking too long or too short, can be just overnight.
I think it's all the above. I mean, I think, like I said, it's like a marriage. It's like you're courting people, and you might have this unique proposition of a company, and it's like, hey, there's some people over here that are interested in that. This is like, they might be part of a group, they might be just an individual. If you're looking for millions and millions of dollars, most likely an individual is not going to be the best,
Mm,
kind of person to go after. But you might find a company, but there are certain companies that invest in certain kind of industries, certain kind of areas that you want to go target to. But a lot of times, like, those guys get a lot of I won't say pitches, but investment opportunities throughout the year, but they might only invest in two or three, right? And
right.
understanding that it might take some time for them to do their due diligence, and don't be weary of them asking a lot of questions, because even in public accounting, when I first started, it was part of the transaction group, and we worked with a lot of private equity firms as they are identifying target companies, and for us to do what's called the quality of earnings. And you're taking a deep dive in their books, and these spreadsheets are pretty massive, and you're just trying to get a real good understanding of the business. And like we talked about, the tighter that ship is, here's the documents, here's the support. It makes it go so much smoother, for that. But from a timeline, like, it can take a little long, right? I mean, there's two people, two parties, so if everyone's talking and communicating pretty fast, then it could go pretty fast. Maybe a month, 2 months. But if not,
Mm.
you've seen it drag out longer. Because you have the attorneys, you have the accountants, you have just many people that are involved with the transaction. So or maybe there's a third party broker, like it's just kind of getting everybody in the same place. So that's what we
Yeah,
say. Yeah, raise money when you don't need it. It's a lot easier.
yeah. And I think that's also kind of the thing is it's dedicating time to it when it doesn't feel urgent is also feels counterintuitive.
Hmm.
For lots of people like, whoa, we're fine now, but why would I spend all this time and energy on on something we don't need right now? But I think it's also the idea that there's also this concept of like, what's the tipping point when it actually starts making sense to actually start worrying about this stuff? Because in the beginning, if you're really just starting out, you don't necessarily don't have the capital, either time or money to spend on a fancy accounting system and a big finance team. But there's a tipping point where if you don't have that, you'll look like the operation will look amateur, if you will, right? And then and then you need to have your ducks in a row and a tight ship to be able to attract investors. So do you have any like rules of thumb about the tipping point when it actually starts making sense to worry about this stuff, or you just
Yeah, and I think it goes back to just having that pulse on that business of, let's say you are early stage, right? And a lot of times, I mean, growth sucks cash, like a vacuum, but it's needed to help grow. So having a good pulse on, the runway, like how much cash are we using and burning, how long do we have, right? And if it's a year, it's like, great, we should start now. If it's 2 years, hey, that's wonderful. I'd still say let's just start, doing this now, because if someone, you find an investor in 3 months, it's not going to hurt. But
right?
I think the alternative is, oh, we only have 2 months, so we need money like today, and that's when it shifts it. Instead of just having good equal conversations, it's more of, hey, you need money. They might want to take more ownership or something because they know like you're in a jam, and
Yeah. Yeah,
so
yeah, you lose leverage in those conversations really quick. Yeah.
yeah, I guess. And how about you? I'd love to hear your thoughts on that too.
Yeah, and I kind of feel like there's that happy balance of working in the business and working on the business, right? Where it's like, okay, if you're always in the weeds and just hustling, but you don't take a step back to say, okay, well, where am I going to be 3 months, 6 months, 9 months, a year from now? Um, you might lose sight of what you need to build today that you're going to need tomorrow. So that's one of those things where it's like, okay, well, we've gotten the proof of concept going on, we've gotten some traction, and now we really need a bigger lump sum of cash to really accelerate this. Okay, well, it might take. That's the time when you're like, we need to start building this out so that a month or two from now, it's pretty cleaned up, and then we
Yep.
can take it out, and it's part of the package we put together. The data, we have all the stuff we need to put into the data rooms, and and then you can when you're off to the races, you can have these conversations. Actually, another thing to talk about is the data room, right? Like what would be included? Is there like a checklist? Can we provide someone with one of those of like what needs
Yeah.
to
Yeah,
put
like
to,
and even for some folks that might not know what that is, but usually once there's like a conversation with a potential either investor, whether that's an individual or company, there's what's called a data room, and this is just a secure area where you can start sharing docs. It's not like sending emails over to each other, but you kind of upload it and you both have access. So, but usually, and I mean, there's usually a lengthy checklist that to go in. But I mean, starting with just the financials and the trial balance of the company, maybe some bank statements, bank reconciliations, just like a lot of the support. Then as they start diving in, because you're doing the work on the investor, but they're doing the work on the business to kind of go through it, whether they're doing it themselves or hiring a third party to look at it. But questions start arising. There's multiple meetings and, hey, what's this? Why did this go down? And just to really understand that business. So there might be additional requests, throughout that process too, until everyone has the information they have, and then kind of finalize like what a deal looks like, and then it's complete. So sounds very simple, but can be very lengthy. So that's why we come back to having the ducks aligned and having everything more in that line of a well-oiled machine, because as things come up, you're like, oh, here you go, here it is. It's like, man, these guys have their stuff together. Here's all the information, compared to we don't have any of this. And then it just starts dragging on. And then sometimes it's like, it's not even worth it. Let's just not pursue this anymore. And then the deal is dead. So I just think starting
That's
early the
what you
better.
want.
Yeah.
You want to be able to stay alive. You want them closed, right?
Yeah. But yeah, I mean, maybe I'm missing something too, but how about you, Chad? Yeah.
Yeah, I mean, I guess, well, I think the big picture concept here is if you have a solid financial reporting process, even if there's pieces that are missing, um, but whatever you're doing consistently and it's well documented, then that can be leveraged to produce the documents that are needed, essentially.
Yeah.
And then if it's consistent and well documented, then it can also be used to leverage to project out in the future, which is also a key part of this activity as well. So I think that's the key is just kind of wherever you're at, you just kind of lead into baby steps, taking baby steps to make it a little bit better. But I think that we are coming up to the time limit here. So it was great chatting with you again, as always, Jeff. And I think we have some concrete takeaways. Just get the well-oiled machine set up and remember to look out for the future. Like not just focus on today.
I love it. I agree. Yeah. Start now and, like you said, get the ducks aligned and start the process, So this is fun. Yeah. Thank you.
All right, well, good stuff. And we will be here. Feel free to reach out if you have more content or more questions, and talk to you again soon.
Thanks, guys.